You hear these whispers, right? In the financial world, these stories, they're almost mythical, turning just pennies into actual fortunes. It's this siren song,
Yeah,
penny stocks.
it is. It's incredibly seductive, that idea.
Yeah. Imagine you put down, I don't know, not a huge amount of money, maybe a few $100 into a stock that's trading for cents.
Pocket change, really.
Exactly. And you suddenly own tens of thousands of shares.
Yeah.
And then you just watch it explode.
That's the dream scenario they sell, isn't it?
Totally. Like maybe it goes from 50 cents to $1, boom, 100% gain. Maybe overnight.
Well, that's how the story goes, yeah.
It feels like this shortcut to wealth, and it feels accessible because, well, the shares are so cheap.
And that dream you're describing, it's powerful. There's no denying the pull.
Right.
The low entry cost, owning this huge volume of shares, the pure math of how a tiny price jump means a massive percentage gain. It all feeds into that magnetic attraction.
It taps into something primal, maybe? That hope for a quick win?
Absolutely. The get-rich-quick fantasy. The financial lottery ticket. And that's precisely why this particular corner of the market is, frankly, one of the most treacherous for everyday investors.
It does feel like it gives you a way in, though. A chance to actually play the market without needing, like, a fortune to start with.
Yeah, that feeling of participation is key.
You buy thousands of shares, and it feels like you own a real chunk of something that could be the next big thing. It's pure speculation, but it's wrapped up so nicely.
Wrapped in that alluring package of potential explosive growth, as you said. And that speculative nature, that intense appeal, it brings us right to the core question for this deep dive.
Okay.
On one hand, you've got this pervasive dream, huge gains, small initial outlay, fueled by volatility and that sense of accessibility. But then, what does the actual documented reality tell us?
What do the numbers say? What do the experts say?
Exactly. Are U.S. penny stocks a real path to wealth? Or are they, as regulators and a whole lot of data strongly suggest, more like a high-stakes gamble?
A gamble where the odds are just stacked against you.
Heavily stacked, where losing big is actually far more likely than hitting that jackpot gain everyone dreams about.
Okay, let's really dig into this then. We've gathered quite a bit of material for this deep dive. We're looking at warnings from folks like the SEC, the Securities and Exchange Commission, and FINRA.
The Financial Industry Regulatory Authority, yeah. Their warnings are, well, they don't mince words.
No kidding. And we've also got analysis from financial experts, research firms, even some insights into how these things play out in online communities these days.
And the message coming from all these different angles, it's remarkably consistent. And pretty stark, as you said.
The regulatory warnings especially really highlight these fundamental built-in risks.
They do. So our goal here isn't about trying to pick the winning penny stock, because honestly, the data shows how incredibly rare that is for the average person.
Right, that's not the point.
The point is to understand the mechanics. How does this market actually work? What are the real risks involved? And why is the deck so often stacked against the individual investor trying to make money here?
So we're cutting through the hype, the stories.
Trying to get to the documented reality. What do the facts tell us?
All right. So first things first, let's define our terms. When we talk about a penny stock, what are we actually talking about? The name itself can be a bit misleading.
It can be. The most common definition, the one regulators like the SEC use, is pretty specific. They generally define a penny stock as a security, a stock that trades for less than $5 per share.
Less than $5. Okay.
But it's not just about the price. It also has to be issued by a small company, typically a small cap or micro cap company.
Meaning small market capitalization.
Exactly. The SEC uses a benchmark of less than $250 million in total market capitalization. So small company, low share price, usually under $5.
Some people might think it's just stocks under $1, right?
Yeah, you hear that sometimes. And some brokerages might use lower cutoffs. But that $5 mark from the SEC is important because hitting that threshold triggers specific rules and extra disclosure requirements for brokers dealing in those stocks.
Gotcha. So it's fundamentally tied to the size and structure of the company, not just the pennies per share price.
Precisely. And the fact that these are small or micro cap companies, that dictates a lot of their other characteristics.
So.
Well, think about your typical blue chip stock. A big established company, they've got a long history, usually profitable, proven business model, solid financials.
Right. Stable of giants.
Penny stock companies are often the complete opposite. They might have a very limited track record, maybe no operating history at all. Their business plan might be totally unproven, uncertain,
Or they could be in trouble.
very often. They might be struggling financially, maybe even circling the drain towards bankruptcy. They just lack that stability and predictability you see in larger, more mature businesses.
That's a really crucial distinction. It's not just a cheap version of a big company. It's often something fundamentally different, maybe riskier.
Fundamentally different, and yes, fundamentally riskier. And because they're smaller, less established, and often just can't meet the tough listing requirements of the big exchanges.
Like the New York Stock Exchange or NASDAQ.
Exactly. Because they can't meet those standards, they usually trade elsewhere, primarily on the over-the-counter markets, the OTC markets.
Okay, OTC. What kind of requirements are we talking about that they don't meet? Is it just the share price needing to be higher?
The share price is definitely a big one. NASDAQ, for instance, has rules about minimum bid prices. If a stock consistently closes below $1 for too long, they can get booted off the exchange.
Kicked off NASDAQ and onto the OTC market.
Right. But it's way more than just price. It's minimum market cap, certain financial hurdles like revenue or income levels, having a minimum number of shareholders, and importantly, strict corporate governance and financial reporting standards.
Stuff that gives investors confidence and transparency.
Exactly. Companies trading OTC often don't meet those higher standards, which means they aren't subject to the same level of ongoing scrutiny and public disclosure as companies on the major exchanges.
So trading OTC puts them in this less visible, less regulated kind of space. That sounds like it could open the door to issues right there.
Oh, absolutely. That lack of tight oversight and mandatory reporting in the OTC world creates an environment where, frankly, abuse can flourish. And it makes it incredibly hard for investors to find reliable information.
Which brings us back to why people are drawn in, despite these clear red flags.
It does, that magnetic pull we talked about. Even with all these risks, why do people chase them?
Well, that lottery ticket idea seems huge. The low price just makes it feel so possible.
It really does. It massively lowers the barrier to entry psychologically. You might look at, say, Amazon or Google stock and think, wow, I can only afford a tiny fraction of one share.
Right, it feels out of reach.
But with penny stocks, maybe you have $500. Suddenly you can buy thousands, maybe tens of thousands of shares. That sheer volume gives you this feeling of being heavily involved, like you have a real stake.
Even if the total dollar value isn't huge compared to your overall savings.
Exactly. It feels like you're really in the game.
And then there's that potential for just insane growth. You mentioned the 50 cents to $1 jump, a double up.
That mathematical possibility, however remote in reality, is what fuels the whole get-rich-quick narrative. A tiny price move equals a giant percentage gain.
Which sounds amazing on paper.
It does. But the probability of that move happening sustainably, and for legitimate business reasons, that's incredibly low. And the people who manipulate these markets, they understand this psychological trigger perfectly.
They know how to exploit that hope.
They do. And they combine it with another really powerful emotion, FOMO. The fear of missing out.
Ah, FOMO, that feeling like you have to get in now or you'll miss the boat entirely.
Precisely. Pitches for penny stocks almost always have this element of urgency. This thing's about to pop. You got to act now.
Creating pressure.
Huge pressure. And if the stock price does start to tick up, maybe because they're manipulating it, maybe just random volatility, that triggers FOMO in others watching.
They see it moving, hear the hype.
And they feel forced to buy before it goes even higher, often without doing any real digging themselves. This momentum, driven by hype and FOMO, can create a temporary price bubble.
And you mentioned manipulators are getting smarter about how they do this now, using things like social media.
Yeah, the tactics are evolving. It's not just cold calls or spam emails anymore, though those still happen. Now, according to reports, they might use slick social media ads, maybe promoting what looks like a normal investment club or a finance tips page.
Something seemingly harmless.
Right. But then, if you show interest, they funnel you into these private, encrypted group chats, like on WhatsApp or Telegram.
Encrypted? Why?
Because it's hidden from public view, harder for regulators to track. Inside these closed groups, they can control the narrative completely, push specific low liquidity stocks, and coordinate buying activity much more effectively.
Wow, that's sophisticated and pretty scary, getting people into hidden channels to manipulate them.
It really highlights how they adapt to evade detection and target potentially vulnerable people.
Yeah.
So the appeal is clear, feels accessible, promises massive gains, plays on psychology, uses modern tools. But let's pivot now to the harsh reality, because this is where the data paints a completely different and frankly brutal picture.
Okay, let's get into the numbers. Why are penny stocks fundamentally so risky?
This is really the heart of it, and the evidence is overwhelming. The first huge point is just the incredibly low probability that the average investor will actually succeed. The win rate, you could call it.
What does the data show? How often do people actually pick a winner here?
It's pretty grim. Studies we looked at show retail investors, as regular folks trading for themselves, have a win rate in penny stocks of only about 11%.
11%? That's low.
It's incredibly low. Compare that to professional traders working in the same penny stock space. Even they only manage about a 24% win rate.
So even the pros struggle massively.
They do. And now compare both of those to the typical win rate if you were trading, say, major index stocks, that's closer to 35%. So you are dramatically less likely to make a winning trade in penny stocks.
As a retail investor, you're looking at something like 1 win in 9 trades, compared to maybe 1 in 3 for major stocks.
Roughly, yeah. And it gets worse. When you do lose, the losses tend to be really substantial. They compound that low win rate terribly.
How bad are the losses typically?
The data suggests that around 78% of retail investors lose money in their first year trading penny stocks. 78% lose.
Wow, 4 out of 5, roughly.
And for those who lose, the average loss can be as high as 67% of the money they put in.
Losing 2/3 of your investment capital, on average, if you're in that losing group, ouch.
It's brutal. And for people who trade frequently in this market, it's even more devastating. Sources indicate that 78% of frequent penny stock traders lose over 90% of their capital within just 2 years.
90% wiped out in 2 years for most active traders.
That's what the data suggests. Nearly 4 out of 5 frequent traders basically have almost nothing left of their initial trading capital after just 24 months.
That's not just underperforming the market, that's potential financial ruin for people.
It absolutely is. These numbers really highlight just how destructive this market can be for individuals lured by that quick riches promise. It's not just about maybe not making much, it's about a high likelihood of losing a lot, sometimes everything.
And this ties into the overall performance of the penny stock market itself, right? Not just individual trades.
Exactly. What do the average returns look like for this sector as a whole?
Let me guess. Not great.
Worse than not great. Over the last 3 years, based on the data we saw, the average annual return for penny stocks was actually negative 1.62%.
Negative. So, on average, holding a basket of these stocks lost money each year.
That's right. Meanwhile, over the same period, major stock indices, they averaged a positive annual return of about 12.24%.
So the broad market was growing nicely, but the average penny stock was actually shrinking investor capital.
Precisely. Investing here isn't just less likely to give you those huge gains. On average, it actively destroys wealth over time. That negative average return really bursts the massive gains bubble.
It certainly does. What else contributes to that negative average?
A huge factor is the incredibly high failure and delisting rate among these small companies.
Meaning the companies just go bust or disappear from the market?
Exactly. According to SEC data looking back over 5 years, a staggering 42% of penny stocks were either delisted from whatever market they traded on or trading in them was suspended.
42%, almost half.
And when a stock gets delisted or trading is halted indefinitely, your investment often becomes instantly worthless. Poof, there's usually no market left to sell it in.
So the value just evaporates.
It often does. Another source mentioned something even more shocking. Around 60% of penny stocks approach zero value within just 3 years of trading.
60% essentially go to zero within 3 years.
Yeah. So we're not just talking about stocks that dip in price temporarily.
Yeah.
For a massive chunk of these, it's a permanent total loss of capital because the underlying company fails, runs out of money, or just ceases to exist as a viable entity.
The risk of losing everything isn't just theoretical, it's a highly common outcome.
It's a statistically probable outcome for a large portion of these stocks. And if you look at it from a risk perspective, like how much return are you getting for the risk you're taking?
Using metrics like the Sharpe A ratio.
Right. Penny stocks score terribly, typically in the range of -0.4 to -0.1. A negative Sharpe ratio is basically the market telling you you're taking on a ton of risk and, on average, getting punished with negative returns for doing so. It's the exact opposite of a sound investment profile.
Okay, so just to recap the performance reality. Low win rates, high loss rates, negative average returns overall, and a massive risk of the company failing completely. What other structural issues make this market so dangerous?
A huge one is that lack of information and transparency we touched on earlier related to the OTC markets.
Right, they don't have the same reporting rules.
Exactly. Companies on major exchanges have to file detailed financial reports regularly, quarterly, annually. They hold conference calls. There's a lot of mandatory public disclosure.
So investors can see what's going on financially speaking.
More or less, yes. But companies trading OTC, they often don't face those same stringent requirements. Finding reliable, up-to-date info on their financial health, their operations, their management, their future prospects, it can be incredibly difficult, sometimes flat out impossible for an average person.
Yeah, you're flying blind, essentially.
Often, yes. You might be making decisions based on rumors, hype, or just incomplete data. And compounding this problem is the almost complete lack of professional analyst coverage.
Meaning Wall Street analysts aren't following these companies.
By and large, no. One source cited FactSet data showing that 96% of penny stocks have zero professional analysts covering them.
96%.
Think about it. For bigger companies, you have teams of analysts digging into the numbers, writing research reports, giving ratings. For penny stocks, you're almost entirely on your own to figure things out.
Relying on whatever scraps of info you can find, which might be biased or outdated.
Or outright misleading. And this lack of transparency is also where you run into the risk of things like shell corporations.
Shell corporations, what are those?
Basically, companies that exist only on paper. They might have no real business, no assets, no operations. They're just empty legal structures, often created specifically to be used later in manipulation schemes.
So trying to do proper research, proper due diligence sounds almost impossible for most investors in this space.
It's extremely difficult, bordering on impossible to do it thoroughly enough to make truly informed decisions. And this information vacuum connects directly to another huge risk, very low liquidity.
Liquidity. That's about how easily you can buy or sell a stock.
Exactly. It's about how quickly you can trade shares without your own trading significantly moving the price.
And penny stocks generally don't trade much.
Very little, typically. We saw data suggesting average daily trading volume is often below 100,000 shares.
Yeah.
Compare that to major stocks where volumes are in the millions, sometimes tens or hundreds of millions of shares per day.
Okay, so much, much lower volume. What does that mean practically?
It means there are far fewer buyers and sellers active at any given moment. So let's say you own 50,000 shares of a penny stock and you decide you want to sell them all right now.
Okay.
There just might not be enough buyers willing to pay the current price or anywhere near it to absorb all your shares. Trying to sell even a moderate block of shares can swamp the limited demand.
So you either have to accept a much lower price to get rid of them,
or you might not be able to sell them at all, at least not quickly. You can get trapped, stuck holding shares you want to sell while the price perhaps keeps falling, unable to exit your position for days, maybe even weeks.
trapped in a falling stock because nobody's buying. That sounds like a nightmare.
It absolutely can be. And this illiquidity also messes up standard risk management tools like stop-loss orders.
How so?
A stop-loss order is meant to automatically sell your stock if it drops to a certain price to limit your losses. But if a stock barely trades, maybe only a few times an hour or even less.
Your stop price might get hit, but there's no trade happening.
Exactly. Or the price might gap down instantly, jumping right past your stop price.
Yeah.
So your order might trigger, but then it executes at a much, much lower price than you intended because that was the next available trade. Or it might not execute at all if the price plummets too fast between trades.
So stop losses are unreliable here.
Highly unreliable, and this low liquidity is also directly responsible for those infamous, incredibly wide bid-ask spreads.
Ah, the spread. Explain that again because it's crucial.
It really is. It's a hidden cost that bites you immediately. So you have the bid price that's the highest price any buyer is currently offering to pay for a share.
What someone's willing to pay.
Yes.
Right. And then you have the ask price, sometimes called the offer price. That's the lowest price any seller is currently willing to accept.
What someone's asking for to sell it.
Exactly. The difference between that highest bid and the lowest ask. That's the spread.
And for regular big stocks, that spread is tiny.
Often fractions of a penny. But for illiquid penny stocks, the spread can be enormous. The sources mention typical spreads of 4% to 8%.
4 to 8%, just the difference between buying and selling.
Yes. And sometimes, on top of that, you get what's called slippage, especially if you're trading a larger amount. That means the price you actually get filled at is even worse than the best bid or offer shown, maybe adding another 2% to 5% in hidden cost.
So the total transaction cost could be huge.
It can be astronomical. And that spread represents an instant guaranteed loss the moment you buy shares at the ask price.
Let's use that example from the sources because it really drives it home.
Okay, yeah, it's a powerful illustration. Imagine a stock where the bid is $0.04, and the ask is $0.10.
Okay, 4 cents bid, 10 cents ask, a 6-cent spread.
Right. Now, say you decide to invest $5,000. You have to buy at the ask price, the $10. So your $5,000 gets you 50,000 shares.
Makes sense. $5,000 divided by 10 cents is 50,000 shares.
Now, let's say for whatever reason, maybe you need the money, maybe you just changed your mind. You have to sell those 50,000 shares immediately after buying them back to the market maker or dealer.
Okay.
You can only sell at the current bid price, which is 0.04 cents. So your 50,000 shares sold at 4 cents each would only bring you $2,000.
Wait, I put in $5,000, and if I sell right away, I only get $2,000 back.
Exactly. You would have instantly lost $3,000, or 60% of your investment, just due to the bid-ask spread.
60%. Gone. Just like that.
Just like that. Before you even factor in any brokerage commissions or potential markups the dealer added when selling to you, or markdowns when buying back.
Wow. So the stop price has to go up, what, more than double, just for me to break even?
It has to rise significantly, well over 60% in that example, just to cover the cost of the spread and fees before you even start making a profit. It shows how the very structure of this market has these massive built-in costs working against you from the start.
And it's basically profit for the dealers, the market makers.
Largely, yes. They profit from buying low at the bid and selling high at the ask, providing that often poor liquidity.
And this makes trying to cut your losses quickly almost impossible, too.
Yeah, back to the stop loss issue. Low volume, plus these potential huge price swings we'll talk about next, means stop losses are just not reliable safety nets here. You can get wiped out way past your intended exit point.
So, okay, illiquidity is a massive practical barrier. We've got low win rates, high losses, negative average returns, companies failing, no reliable info, and these crippling liquidity problems and spreads. Is there one more major risk factor that kind of ties it all together?
Oh, absolutely. This market is notorious, infamous really, for market manipulation, specifically the classic pump and dump scheme.
Pump and dump. We hear that term a lot.
And for good reason. While these scams aren't new, the unique vulnerabilities of the penny stock market, the lack of info, the illiquidity, the weaker oversight, combined with modern communication tools, make it incredibly fertile ground for them.
Okay, so walk us through how a typical pump and dump works in this environment.
Sure. The pattern is pretty predictable, according to the sources. Step 1. The manipulators, the fraudsters, quietly start buying up shares of a very low-priced, thinly traded stock.
Accumulating shares without drawing attention.
Exactly. Because it trades so infrequently and there's little transparency, they can often acquire a huge chunk of the available shares, sometimes controlling most of the public float without causing the price to spike prematurely or setting off regulatory alarms.
So they get control of the supply, basically. What's next?
Then comes the pump. They unleash a massive promotional campaign designed purely to artificially inflate the stock's price.
How do they promote it?
All sorts of ways. Mass emails, spam, misleading newsletters, posts on online stock forums and message boards, social media hyping, and increasingly using those private encrypted chat groups we discussed.
Pushing it out through hidden channels, too.
Right. And the content of the promotion, it's filled with false, exaggerated, or totally misleading positive news.
Like what kind of fake news?
Oh, this tiny company just discovered a revolutionary new technology. They've landed a massive, secret government contract. They're about to be bought out by a huge corporation. Miracle drug approval is imminent. Anything to create buzz and a false sense of urgency and enormous potential value that simply isn't real.
Creating a completely fabricated story.
Precisely. They build a false narrative to generate hype. This hype, combined with maybe some initial buying by the manipulators themselves to get the price moving upwards, starts to attract attention.
From unsuspecting investors.
Exactly. Regular investors, maybe momentum traders, see the price going up, they see the promotional buzz online, and they jump in. FOMO kicks in hard. They think, wow, this must be real. I got to get in before it goes higher.
So the victim's own buying pushes the price up further.
Correct. Their buying fuels the rally, making the scam look even more legitimate to the next wave of potential victims. It creates this illusion of genuine market interest. The sources also mention a variation called ramp and dump, which might involve a slightly slower, more gradual price increase to seem less suspicious than a sudden spike.
Okay, so the price get pumped way up on false pretenses.
Yeah.
Then what?
Then, once the price is sufficiently inflated, usually at the peak of the hype comes the dump,
The manipulators sell.
They sell. The original fraudsters who bought their shares way down low for pennies or fractions of a penny start unloading their entire massive position onto the market, selling to all the unsuspecting buyers who were lured in by the pump.
And because the stock is illiquid, and this is a huge amount of selling pressure.
The market just collapses. There's no way it can absorb that flood of sell orders. There are no real buyers at those inflated prices, only the victims who bought on the way up. The artificial demand created by the promotion evaporates instantly as the promoters stop pumping and start dumping.
So the price just tanks.
It plummets, often crashing back down to its original low price or even lower, sometimes becoming virtually worthless in a matter of hours or days.
On the manipulators.
They walk away with enormous profits, having sold their cheap shares at the artificially high prices created by their scam. Meanwhile, all the investors who bought during the hype, they're left holding the bag, stuck with stock that's now worthless or near worthless, having lost most, if not all, of their money.
They bought high, sold low, or couldn't sell at all. It's a devastating cycle.
It truly is. And penny stocks are just perfect targets for these schemes because of all those vulnerabilities we've talked about.
Right. The lack of real info makes it easy to spread lies.
The low liquidity means even small amounts of buying or selling can move the price dramatically.
And the weaker regulation in the OTC markets gives them more room to operate.
Exactly. Less scrutiny. Plus, sometimes trading in a specific penny stock might be dominated by just one or two market-making firms. If they're involved in the manipulation, they have immense power to control the price quotes.
It paints a very clear, very dangerous picture. So given all this, what can investors actually do to protect themselves? The sources offered some really crucial warning signs and practical tips.
Awareness is absolutely key. Number one, be incredibly wary of high-pressure sales tactics.
The urgency thing again.
Yes, anyone pushing you to invest immediately. Using phrases like, you have to act now, this is a limited time opportunity, it's about to take off. Huge red flag. Legitimate investing involves careful thought and research, not snap decisions under pressure. Building a real company takes years, not days or weeks to decide.
Makes sense. What else?
Be extremely skeptical of anyone guaranteeing profits or claiming an investment is risk-free or that they can protect you from losses. Those kinds of guarantees are illegal for registered professionals and are classic signs of fraud.
Okay, no guarantees. What about people contacting you out of the blue?
Huge danger sign. Be incredibly cautious if a stranger contacts you unexpectedly, especially through social media, direct messages, or those encrypted chat apps.
Even if they seem friendly at first.
Especially then. Fraudsters often use clever pretexts. Maybe they claim they messaged the wrong person or they flatter you just to start a conversation. But soon enough, it often pivots to talk about some amazing can't-lose investment they're involved in. Just don't engage, block them, report them. Don't get drawn into unsolicited investment pitches from strangers.
Got it. What about those ads you see online or groups promising amazing returns, like investment clubs?
Treat them with extreme skepticism. Many are just fronts designed to gather names of potential victims for pump-and-dump schemes. Always check the background of anyone promoting an investment.
How do you do that?
Use the tools available from regulators. FINRA has a tool called BrokerCheck Online. Your state securities regulator likely has resources too. You can look up individuals and firms to see if they're properly licensed and, crucially, if they have a history of complaints or disciplinary actions.
And don't just trust the phone number they give you.
No. Call the firm's publicly listed phone number from their official website or directory listing to verify the person actually works there and what their status is. Don't rely on contact info provided directly by the promoter.
Good tip. What about the companies themselves that are being hyped?
Be very suspicious of promotions for tiny companies, microcap stocks you've literally never heard of before, especially if the pitch is vague about what the company actually does, or worse, if they suggest you borrow money to invest.
Borrow money, like from your house.
Yes. Alarmingly, some scams suggest taking out a home equity line of credit, a ADLOC, which is basically a loan secured by your home equity. Never, ever borrow money, especially against your home, to invest in something speculative like a penny stock. That's incredibly dangerous advice.
Definitely sounds like it. Any other company red flags?
Avoid anything called a blind pool or a blank check company. That's where you invest money without even knowing how the company plans to use it. Total lack of transparency. Also, be wary of companies that seem to have no real business operations, few assets, no clear history. These are often those shell corporations primed for scams.
So unknown person plus unknown company plus suggestion to borrow, run away.
Run far and fast. Also, watch the stock's behavior. If a stock that normally barely trades suddenly spikes in price and volume for no apparent reason or news, that could be a pump and dump already in progress.
How can you check that?
Use publicly available tools. Antauray's market data website, for example, lets you look up historical price and volume charts for stocks, including OTC securities. Look at the pattern over months or years. Does the recent activity look like a sudden artificial spike compared to its normal behavior?
Okay, check the history. What about the paperwork when you actually trade?
Pay very close attention. Look at your trade confirmation slips. If your broker recommended or pitched the stock to you, but the confirmation is marked unsolicited, that's a problem.
Why is unsolicited bad if they recommended it?
Because unsolicited means you supposedly initiated the trade without their recommendation. It might be their way of trying to dodge responsibility later if the stock tanks, claiming it was your idea.
Sneaky. What else on paperwork?
Carefully review your new account forms or suitability questionnaires. Does the information accurately reflect your real financial situation, your investment experience level, and your actual goals? Sometimes unethical brokers might inflate your net worth or experience on paper to make risky investments like penny stocks seem suitable for your account when they really aren't.
So they fudge the numbers to justify selling you garbage.
It can happen. You need to make sure those documents are accurate.
What if something even worse happens, like you see stocks in your account you know you didn't buy?
That's unauthorized trading, and it's extremely serious. You need to act immediately. Complain verbally to the advisor, but always follow up in writing. Send copies of your written complaint to their branch manager, the firm's compliance department, and also file formal complaints with the regulators, FINRA, NASA, the State Regulators Association, and your specific state securities regulator. Document everything. Act fast.
Okay, immediate written complaints everywhere. Good to know.
And knowing who you're dealing with, the broker and the firm, is critical. Because penny stocks are so illiquid, you might actually need that original brokerage firm to be able and willing to sell your shares later if a buyer even exists.
So you need to trust the firm itself.
You need to investigate them. Use BrokerCheck and state resources to check the firm's history and the individual broker's record before you do business. Are they properly licensed? Do they have a history of complaints or regulatory actions? Be extra cautious if the salesperson who sold you the stock suddenly leaves the firm.
What happens then?
You have rights. You're not obligated to keep your shares at that firm or transfer them to wherever the salesperson went. You have the right to request the physical stock certificates from the firm that sold them to you, though dealing with physical certificates can be cumbersome.
So homework on the person, the firm, not just the stock.
Absolutely critical. And it may be the most fundamental advice, though, again, hard in this market. Try to do your own independent research on the actual company.
Don't just take the salesperson's word for it.
Never. Don't rely solely on promotional hype or what they tell you. If any real information exists, check for financial statements. Read about their business model. Look into the management team. Understand their market. It's often difficult, but you have to try.
What if it's a brand new company, like an IPO?
If it's a penny stock IPO, meaning it's the first time shares are offered to the public, definitely read the prospectus document carefully. That's legally required disclosure. But even then, understand that the outlook for new, small companies is incredibly uncertain, and their financial situation can change very rapidly.
Okay, so research is key, even if challenging. Given all these risks, limiting how much you expose yourself seems vital.
Absolutely essential. The sources are unanimous on this. Penny stocks are pure speculation. They should only be considered using money you can genuinely afford to lose completely. Like, if it went to zero tomorrow, it wouldn't impact your life goals, your retirement, your ability to pay bills.
This isn't your retirement nest egg money.
Absolutely not. It should never be a core part of your portfolio.
Yeah.
Many experts suggest capping speculative investments like penny stocks at a very small fraction of your overall portfolio, maybe less than 5% if you decide to dabble at all.
Keep the gamble small if you gamble. What about using specific order types when trading?
Yes, crucial point. Because of the wild volatility and the terrible liquidity, always use limit orders when buying or selling penny stocks.
Limit orders, not market orders. Why?
A limit order lets you set your maximum buying price or your minimum selling price. So you're saying, I won't pay more than X or I will accept less than Y. This protects you from getting a terrible execution price if the market suddenly swings wildly or if there just aren't shares available at the price you saw a second ago. A market order just says, give me in or out at the best available price, which could be disastrously bad in this market.
Limit orders give you price control.
Central price control in a volatile, illiquid environment. And finally, perhaps the most important mindset shift.
What's that?
You have to go in fully accepting the high probability of total loss. The overwhelming majority of people who play in this market lose money. Often they lose most or all of it. If you are not psychologically and financially prepared for your entire penny stock investment to evaporate, to go to zero, you simply shouldn't be involved.
Assume it could all disappear. That's a sobering thought.
It's the realistic starting point, according to all the evidence.
Okay. It's clearly a very challenging, high-risk area. The sources did briefly mention some other strategies that people with smaller amounts of capital might look at, things that offer potential growth but have different kinds of risks than these penny stock pitfalls.
Yeah, they touched on a few alternatives, but it's super important to stress that these also carry significant risks and aren't magic bullets. They're just different beasts.
Like what?
Well, one mentioned was options trading. Options contracts can give you leverage. You can control a larger amount of underlying stock value with less capital up front than buying the stock itself.
Leverage. So smaller moves can mean bigger percentage gains or losses.
Exactly. That leverage creates the potential for explosive returns, but options are complex. They expire. They require a lot of knowledge to trade effectively. And you can easily lose your entire investment, the premium you paid for the option, very quickly. High risk, high complexity.
Okay, so options. Potential leverage, but steep learning curve and high risk. What else?
Leveraged ETFs were mentioned. These are exchange-traded funds designed to amplify the daily return of an index or sector, maybe 2x or 3x.
So if the index goes up 1%, the 3x ETF aims for a 3% gain that day.
Roughly, yes. But they amplify losses just as much. And crucially, because of how they're structured with daily resets, they're generally only suitable for very short-term trading, like intraday. Held longer, especially in choppy markets, their performance can decay badly due to compounding effects. They are definitely not buy and hold investments.
Amplified gains and losses, really only for super short-term bets. Got it.
And then one source discussed a strategy called event-driven trading.
Event-driven. What's the idea there?
The concept, as presented, is to identify trading opportunities, specific entry and exit points based around predictable scheduled events. Think company earnings reports, FDA drug approval decisions, major product launches, things like that.
Trying to trade around known catalysts.
Exactly. The claim is that by strategically positioning yourself before or reacting quickly after these known events, you might capture rapid gains related to the event's outcome. It suggests this approach could offer efficient capital use and potentially be applied even to more established blue-chip stocks, not just speculative ones. Some providers might even use AI tools to help scan for and analyze these upcoming events.
So it's less about the company's long-term prospects and more about short-term price moves triggered by specific news.
That seems to be the focus of that particular strategy as described. It's presented as an alternative way to seek gains, potentially faster ones, by focusing on these catalysts. The sources included a table comparing penny stocks versus options versus leveraged ETFs versus this event-driven approach, highlighting their very different risk levels, leverage types, and suitability for different traders or timeframes.
So options, leverage ETFs, event-driven trading, different ways to approach the market, maybe with smaller capital, but all come with their own significant risks and require specific know-how. They're not simple substitutes for avoiding penny stock dangers.
Absolutely not. They each demand careful study and risk management. Now, stepping back to penny stocks themselves, is there ever a situation where buying one could be a legitimate investment, not just a wild gamble?
Can you find a diamond in the rough?
Well, the sources do concede that not every single company trading OTC for pennies is an outright scam or doomed to fail immediately. It's possible that some are legitimate small businesses, maybe early stage, maybe struggling, that just haven't met the requirements for a major exchange listing yet.
So a genuine, potentially growing company could be hiding in there.
The theoretical possibility exists, yes. But, and this is a huge but, the conditions you'd need to meet to successfully find and profit from such a company are incredibly daunting, almost impossible for the average investor.
Why so difficult?
First, you'd need an almost expert-level ability to pick the right one, to accurately assess its business plan, its management team, its financials, its real growth potential, all using the very limited, often unreliable information available in the OTC market.
So you need amazing research skills working with terrible data.
Pretty much. Second, let's say you miraculously find a genuinely promising tiny company. You then need the financial resources and, just as importantly, the patience and discipline to hold that investment potentially for years. Real business growth, especially for small startups, is usually a very long, slow grind. It's not overnight riches.
You need staying power.
Definitely. And third, even if you pick the right company and hold it patiently, you still need a huge dose of luck. The overall economy can turn, competitors can emerge, key people might leave, and tragically, even a legitimate small company trading in this space can still become a target for market manipulation just because it's vulnerable.
Yeah, so even a good company can get dragged down by the bad neighborhood it lives in.
That's a good way to put it. Its stock price can be manipulated, hurting legitimate investors, even if the underlying business is sound. The volatility and manipulation risk inherent in the penny stock market infects everything there.
So while the theoretical possibility of finding a winner exists,
The practical reality is that the immense difficulty in identifying it, the need for long-term capital and patience, the inherently high failure rate of small businesses anyway, and the pervasive risk of fraud and manipulation make succeeding with penny stocks incredibly improbable for most people. The overwhelming statistical risks just swamp that tiny theoretical possibility.
okay. This has been, well, incredibly thorough, and frankly, quite a sobering deep dive into the world of U.S. penny stocks, all grounded in the data and regulatory warnings we looked at.
It really has. And the key takeaways, I think, are stark. They should stand as a really strong counter-narrative to that seductive siren song of easy riches we started with.
The allure is strong, no doubt.
Undeniable. The low price, the dream of those huge percentage gains, that feeling of being able to participate. It's powerful. But the documented reality is defined by critical problems.
Like the terrible liquidity.
Extremely low liquidity, making it hard to buy or sell, and creating those cripplingly wide bid-ask spreads that mean you lose money right off the bat.
The lack of information.
A fundamental lack of reliable data and transparency, making real research almost impossible for most people.
The wild volatility.
Extreme price swings that are unpredictable and hard to manage, and maybe worst of all,
The manipulation.
highly susceptible to market manipulation, especially pump-and-dump schemes that fleece unsuspecting investors.
And the actual results of these risks, according to the data, are
Just brutal. Overwhelmingly low win rates for retail investors, devastatingly high loss rates, often losing 60%, 70%, even over 90% of capital, negative average returns for the sector overall, and a very high probability that the specific company you invest in will simply fail or get delisted, wiping out your investment completely.
So recognizing those warning signs you talked about is just paramount.
Absolutely critical. High-pressure sales tactics, unsolicited contacts from strangers, especially online or in encrypted apps. Hype about tiny, unknown companies, any suggestion to borrow money to invest, sudden, unexplained price spikes in illiquid stocks, and checking your account statements and paperwork carefully for any red flags or inaccuracies. It demands extreme caution.
Extreme caution, yes. Rigorous research, which is often impossible. Strict risk management, meaning only risking money you can truly afford to lose, keeping it a tiny part of your overall plan. And going in with the clear-eyed understanding that losing everything is not just possible, but statistically quite likely.
For most people trying to build wealth seriously,
Focusing on more stable, transparent, regulated investments, things with track records of positive average returns over the long term, is almost certainly a far safer and more reliable path.
Okay, so considering everything we've discussed, all the data on low wins, high losses, the manipulation, the lack of transparency, illiquidity, company failures, it really forces you to ask a final question, doesn't it?
What's that?
When people chase penny stocks, drawn in solely by that dream of the massive gain, is what they're doing really investing the traditional sense?
Yeah.
Putting capital towards a productive business.
Or is it something else entirely? Yeah. Is it closer to just pure speculation driven by hype and hope? Or maybe even closer to gambling, where the odds are heavily stacked against you by the house? What is that powerful desire to hit the jackpot blind investors to? And what's the real documented cost financially and maybe even emotionally of chasing that penny stock dream?